Happy Friday, Eric Bible with the Bible team at Neil Home Loans. And yes, another Friday and more volatility with mortgage interest rates. As we kick off this Friday, the 30-year fix opens at 6.92, which is up from last week's 6.68. And at this point, many are asking and speculating, well, we anticipated that the Fed rate cut was going to drive mortgage rates lower, leaving many analysts and forecasters kind of scratching their head as the anticipation walking into the end of the year or this time of the year was that interest rates would be lower. And yet here we are, interest rates 0.75% higher than from when the Fed cut rates for the first time in this cycle. So the question becomes, what's driving this surge? What can we be looking to? How can we use this in this moment to remain calm and still drive business? And that's ultimately what I want to dive into this week. So as we know, the Fed does not control long-term rates. I've spoke on this in multiple weeks. We've reported across this where, yes, the Fed did cut rates. There was a ton of relief when that finally started. But as we knew that this could be auxiliary fallout, given the fact that the Fed ultimately controls short-term rates, not long-term rates. Now, I still do believe adamantly in my core that mortgage interest rates will go lower. But the road to lower, as we've seen over the last few weeks, is going to undoubtedly be rocky. And we have to take into consideration what's happening from a geopolitical standpoint, financial standpoint, both domestically and abroad, to really understand what this intermittent path looks like to the long-term destination. So big things that I want to cover here are why we've seen this recent surge over the last few weeks and when we can expect things to cool down. So first and foremost, the surge in bond supplies. Now we look at every October going back, I look back the last 4 years, but we could probably push that back 6, 10, 15, the list goes on. Every October, we're coming at the conclusion of our United States fiscal year. At this point, new debt has to be issued in order to finance future projects. There we see more debt, bonds, treasuries hitting the market. With that, given this time too, the number of buyers, institutional money, purchasing this type of debt, security instrument, whatever we want to call it, spikes, which in turn drives yields down, which ultimately drives mortgage rates higher. This has happened the last 4 years, and yes, history always has a way of repeating itself. Best context, on October 23rd of 2023, we hit the highest point in mortgage interest rates through that cycle, where we know interest rates broke above 8%. We're in the same channels. Now, yes, rates are 1% better, arguably a little bit better than they were this time last year, but it's this cyclical nature that we've seen. Inflation is yet again another concern, as we've seen in some of the most recent inflation reports, where yes, inflation has cooled down. With the upcoming election and a potential for divided government, there is concern that inflation will come back into the equation, which in turn has got bonds, which has put pressure on mortgage interest rates really into the conversation. And then lastly, the potential for economic stimulus. Now, in no way, shape, or form is this intended to be political. Again, who you vote for is your call. Does not make any difference into what I'm going to say here, as I'm referencing purely the market. The market has kind of telegraphed that they're anticipating the Trump trade. And as we look back to 2016, when his candidacy took office, we saw mortgage interest rates, bonds deteriorate. There is now growing speculation of a red sweep, which will be historically inflationary. The bonds are preparing for that, which in turn why we're seeing rates do what they do. So what does this all mean? What can we take from this? How can we use this to our advantage and help telegraph to our consumers of what kind of this road ultimately looks like? And again, as we use history as our best reference point to telegraph forward. So looking back to the individuals that made the decision to purchase every October past and what byproduct came thereafter. Historically, this time of year, we see individuals step out of market. We see more listings come on, as we've seen. Yes, we're still below pre-pandemic levels, but there's more inventory. Yes, rates are higher, but buyers are fearful at the moment. They've taken a pause. Individuals that have been beat out, looked over, you name it, submitted multiple offers and have not had the opportunity to win, this moment in time can be just that, the opportunity to win. And as I've mentioned before, and really what I believe to my core is that we will see lower rates here in the hopefully not so distant future. The individuals that take advantage of the market right this very minute will set up to improve their debt structure down the road. Individuals, again, that bought in October of 2023 when rates were over 8% had an opportunity to refinance into the sixes or later or in the past of this year, just a few months back. So they had an opportunity to get the house while it's still appreciated and restructure the debt thereafter. Same is true in this environment. So again, where yes, it is incredibly fearful right now. And yes, seeing rates just incrementally increase week after week creates a level of anxiety. But we know that this is temporary. The road to our destination was never going to be that smooth sailing. So here, we've got to enjoy the ride, take advantage of the scenery, and use it to our advantage. If you are finding yourself struggling in communicating these points to your clients, your buyers, your sellers, know that we're here as a resource. We want to help. As always, let's make it a fantastic Friday and an even greater weekend. Thank you.